The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. The luxury fashion market is facing a complex and evolving landscape. As global economic conditions tighten, core luxury markets such as the U.S., China, and Europe are experiencing a significant shift in consumer sentiment. Real household income and spending growth are forecast to remain below pre-pandemic levels through 2029, putting pressure on discretionary sectors, particularly luxury goods. Meanwhile, rising luxury price inflation, questions around value and authenticity, and the rise of affordable luxury brands are reshaping how consumers engage with high-end fashion. How are macroeconomic pressures then and trade policies influencing consumer behavior, and what role do perception, pricing, and brand positioning play in sustaining long-term growth? Well, to find out more, joining me now is Lydia Burton, who is the Associate Analyst of Food and Drink at BMI. Lydia, welcome to the show.
Hi, it's great to talk to you.
Great to have you on. Lydia, given the current economic climate, what are the main reasons behind a projected slowdown in luxury spending across key markets like the US, China, and Western Europe?
So our core view is that a weaker consumer spending environment in the core luxury markets, which, as you've mentioned, are the US, China, and Europe, or more specifically Western Europe, will drive weak luxury spending growth going forward. And the key driver of this is that increasingly challenging macroeconomic conditions across the regions will weigh on household purchasing power. Speaking to China as one example, China has seen muted luxury demand in recent years in the face of sluggish economic conditions, accounting for additional uncertainties at present from trade tensions alongside the property market. We expect to see increasingly conservative spending attitudes over the next few years, which will likely put a downward pressure on luxury spending. Now, within this economic climate, a key driver of a luxury slowdown is that the rapid expansion of the luxury market in recent years, alongside high luxury goods inflation, have significantly weakened many luxury goods value proposition. So essentially, what this means is that a wedge has been created between perceived product value and quality, as consumers across the globe are beginning to doubt the exclusivity and the craftsmanship of luxury fashion, which is really at its core. And as a result of this, aspirational luxury consumers who face increasingly squeezed budgets will be less willing to pay the price tag for luxury goods. Now, an important distinction I do want to make here is that ultra-luxury consumer demand will remain strong within this environment. Meanwhile, aspirational luxury demand will likely take a hit.
Okay, so how are shifting trade policies and tariffs affecting household spending behavior, particularly in high-end discretionary segments like luxury fashion?
Yeah, that's a really good question. So in the US, tariffs on luxury good imports from markets such as Europe will likely put downward pressure on aspirational spending in the US market. And this really is concerning for retailers who previously relied on the US as the growth market. Trump recently threatened a 50% import tariff on EU goods. Now, I should caveat here that Trump has previously U-turned on tariff policies, and this threat has now delayed until July. However, if tariffs such as these do go ahead, they will have vast implications for European luxury retailers operating in the US market.
Definitely.
And the key reason for this is that higher costs will likely be passed on to consumers in higher prices. And given the weakening of luxury's value proposition in recent times, as I mentioned previously, further price increases will likely be met with a drop in demand. However, an important point to note here, and one which I have alluded to previously, is that the aspirational luxury spending will likely fall. Meanwhile, ultra-luxury spending will be maintained. And the reason for this is that ultra-luxury, ultra-high net worth consumers are less price sensitive and less impacted by market fluctuations. And this will leave purchasing power and demand for ultra-luxury goods relatively stable, whereas aspirational luxury consumers, on the other hand, they often make purchases based on perceived value and affordability. So when prices rise due to tariffs, demand is likely to fall. Kind of on some key developments which we've been tracking here, a key metric we have been monitoring is the global S&P luxury index, which reflects investor expectations of future earnings in the wider luxury sector. And this index has fallen significantly in kind of the largest tariff situations. So Liberation Day, which was Trump's first kind of sweeping announcement of tariffs at the beginning of April, the global S&P luxury index took a significant fall. And again, last week, with Trump's announcement of 50% tariffs on EU exports, it fell again. So what this means is that the market is increasingly pricing in lower future earnings for luxury retailers as the market becomes ever more challenging.
Recent policy shifts have impacted the U.S. luxury market's growth trajectory. So how do you see increasing import costs and weaker consumer demand reshaping the strategies of luxury retailers in the U.S.?
Yeah, this is something that we have been thinking about a lot at the moment. I would say that on a broad scale, we will likely see retailers hiking prices in the U.S. Now, there is definitely some scope for a sharing of costs across supply chains, including the luxury brands themselves eating some of that extra tariff cost. According to Bloomberg, luxury goods' median gross profit margin is around 70%. And what this means is that brands will have some flexibility to work with suppliers and retailers to distribute that tariff cost. However, it is likely that a chunk of the tariff cost will be passed on to consumers. In terms of kind of the split between ultra-luxury and aspirational consumers, those ultra-luxury brands such as Hermes is one example, also Dior and Chanel fall into that category. They will be better placed to pass the tariffs on to consumers, given the fact that their kind of target consumer base has a relative lack of price sensitivity. And there have been some company announcements actually regarding this point. For example, LVMH, which owns kind of a host of luxury fashion houses such as Louis Vuitton, recently said on an earnings call that the company was prepared to increase prices if tariff talks fail. Meanwhile, on the other hand, it has been reported that Richemont, which is an ultra-luxury Swiss company specializing in kind of ultra-luxury jewelry and watches, aims to limit price increases so as not to jeopardize that value proposition, which we've been speaking about previously. So ultimately, it will be a case of brand-specific strategies, which will cater to the brand image and the target consumer base, while really attempting to maintain that exclusive value at the core of luxury. And one kind of key trend that I would like to mention here, and one that we really expect retailers to tap into in the face of weakening not only US but global luxury demand, is experience culture.
Right.
We've witnessed a shift in consumer preferences towards experiences and away from material possessions. And a really interesting way that fashion houses are tapping into this trend is blending fashion with hospitality to create a kind of immersive experience. And there are many examples of this across fashion houses already, such as, for example, Tapestry, which is an American brand owning the likes of Coach and Kate Spade, running kind of cafe pop-ups alongside Prada's Cinematic Cafe and Louis Vuitton's Gourmet Lounge, which is a recent development. So yeah, these are kind of some key ways that brands will be able to tap into that experience culture trend to really regain that aspirational luxury demand, which is threatened at the moment.
Right. Well, Lydia, let's, on that note, dive into some of the consumer trends that are influencing the luxury market. I mean, over the recent years, demand for loud luxury, or so-called logomania, has eased, with consumers opting for statement pieces with minimal brand display. I mean, brands like Loewe and Miu Miu, they're gaining traction with unique minimalistic designs. How significant is this trend in reshaping consumer expectations and influencing broader design strategies across the luxury sector?
Yeah, it is very significant. And this is as it speaks to a growing base of consumers who value recognizable designs rather than loud and recognizable logos. So flash and globally recognized logos, which are also very prevalent across kind of counterfeit goods, have really lessened the exclusive and the rare quality of luxury, which is really kind of at luxury's core. So instead, consumer interest has been shifting towards product design and uniqueness rather than bold brand recognition, which is conventionally displayed through kind of repeated logos or large monograms. Mm-hmm. And we have seen luxury brands rebranding in accordance with these trends. So a couple of examples, Louis Vuitton and Gucci, which are kind of traditionally known for their repeated monogram displays on the products, have been reinventing their classical models with more minimal design options to tap into this type of consumer demand. However, I want to stress here that there will still be that demand for the bright logos, as this is kind of associated with, a symbol, a status symbol.
Right.
So there definitely will still be demand for logos, but there is a growing base of consumers increasingly valuing minimalism as well.
Okay. Well, recent performance data also suggests that there is a growing gap between ultra-luxury brands like Hermes and aspirational brands like LVMH and Kering. What's driving this divergence?
Yeah, so this is a really key point actually in our luxury market outlook, and one which I have pointed to previously. Essentially, what is driving the divergence is that within an environment where consumers in Europe are very price sensitive, and also in the other key markets such as kind of the US and China, as consumers are becoming increasingly price sensitive and are seeing their budget squeezed, we are going to see that base of aspirational luxury consumers who will typically buy from aspirational names such as Louis Vuitton and the brands that Kering owns as well. So we will likely see demand for those kind of brands wane in the coming years. Meanwhile, ultra-luxury brands like Hermes and also Richemont, another brand I mentioned earlier, is another key example of this. The consumer base that they target, which are the ultra-luxury consumers, are less price sensitive, they're less affected by market fluctuations. And so in times of economic uncertainty or macroeconomic headwinds, they will retain this strong consumer demand, which means that those type of companies are expected to continue to see high profits. And as you've mentioned, recent performance data has shown a growing gap. I mean, there's quite a stark difference really with Hermes, for example, actually recovering really pretty well from the Liberation Day dip, which pretty much all of luxury companies faced then. Meanwhile, we have seen brands such as Gucci, Versace, Louis Vuitton are really struggling to recover their share price, which means that investors are more bearish towards the aspirational names, meanwhile have a much more bullish outlook towards the ultra luxury brand names such as Hermes and Richemont.
Okay. Well, the growth of the secondhand market and circular economy, one of the most major recent consumer trends, it looks like it remains a key risk to the established luxury players. So, Lydia, how do you assess the growing preference for secondhand luxury items, especially among Gen Z and millennial consumers? What does this mean for the long-term profitability of new product lines?
Yeah, so there will always be demand for new product lines. However, we do expect the second-hand market to expand, and this will negatively impact the sale of new luxury goods. So Gen Z and millennial consumers, as you've mentioned, showing a deeper interest in ethical production methods, longevity, and also value for money alternatives. And so this really aligns with, the circularity principles of secondhand luxury, not only as a way to access cheaper luxury products and to repurpose old items, but also to really align with that kind of circular, sustainable view, alongside the fact that vintage products have been gaining traction across the consumer markets. And so the secondhand luxury markets will kind of take some of that aspirational luxury demand. However, this does present an opportunity for retailers to actually tap into the secondhand trend. And so we may increasingly see luxury products not only sold on secondhand, often kind of online marketplaces such as Vestiaire is one example, but we may actually see some of these brands kind of offering their own secondhand repurposed range. And so while definitely the secondhand luxury market is a threat to the more aspirational luxury names, it does also present an opportunity which these names can tap into as well.
Well, overall, Lydia, how is luxury goods price inflation influencing consumer perception of, value and quality in the sector? Are consumers becoming more skeptical about what they're really paying for?
Indeed. That's the crux of the problem, really, is the fact that this price-value equation is in question. And also, in terms of skepticism, this has been made worse recently, actually, by viral videos of Chinese manufacturers circulating on social media sites like Instagram and TikTok, claiming that luxury brands are manufacturing their products cheaply in China and only finalizing the product in Europe. And so in this way, and we're talking about kind of made in Europe luxury names here. And so in this way, this does not differentiate luxury goods products substantially from their fake counterparts sold for significantly less. But yes, overall, people are definitely more skeptical of high price tags. They're also wary of increasingly high price tags. And so within this environment where luxury's value proposition is threatened, it will be a requirement that brands do tap into kind of some of the trends that we've mentioned, and also some other trends such as Miu Miu, for example, which has seen kind of a significant outperformance in terms of its share price, kind of experimenting with bold pieces, experimental designs, sustainability also. So yeah, I think it's a challenging environment, but it's one that brands can definitely navigate and kind of alter their strategies to really maintain that aspirational demand.
Right. Some great insights from you there. Well, thank you so much, Lydia, for joining me today.
Great. Thank you for having me.
Thank you. That was Lydia Burton, who is the Associate Analyst at Food and Drink at BMI. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.